Welcome. In a previous lecture, we looked at the IRS process for recovering cost of real or personal property, the process called depreciation, and the IRS standard called MACRS. In this video, we're following the transaction through its usage to its disposal. We'll look at how to calculate the realized gain or loss, how to calculate the recognized gain or loss, which occurs when an economic transaction justifies it. And finally, we'll look at a couple of different gain or loss transactions that receive special treatment under the tax code. As a means of review, it's important to point out the difference between a capital gain or loss and an ordinary gain or loss, because your textbook material refers at multiple points to how the gain or loss is treated. A capital loss or gain is generated when the asset surrendered is a capital asset and the transaction triggering the gain or loss is a sale or exchange. An ordinary gain or loss occurs on any other type of gain or loss. Capital gains have special further treatment depending on whether the asset was held for a long term or a short term, with a year being the cutoff between the two. Now, how a tax-paying business accounts for its gains or losses on disposition of property. Now, disposition can mean sale, exchange, destruction, any of the above. Depends on three factors: what the amount of the gain or loss is, what the timing of the gain or loss is, and whether the tax code has special treatment for that specific gain or loss. By way of review, a gain or loss is computed on the difference between the adjusted basis and the amount realized from the sale. An activity has to have occurred for a business or individual taxpayer to take advantage of a gain or loss. That is, until a certain economic transaction occurs, the loss or gain is just theoretical. When the economic activity occurs, it creates a taxable transaction. Now let's look at a little more detail in that formula for a gain or a loss. A gain or loss is computed as the difference between the realized amount of sale less the adjusted basis in the property. If the amount realized is greater than the adjusted taxable basis, then a gain transaction occurs. If the amount realized is less than the amount of the adjusted basis in the property, then a loss occurs. Now let's look in a little more detail at what goes into the realized amount of sale. There's the legal tender that's given in exchange for the property. Now this can include actual legal tender, or it can include the assumption of the seller's debt on the assets. Fair market value is the price paid in an open market for the property. An open market is one in which the buyer and the seller are both engaging in the transaction voluntarily, and where both parties have enough knowledge of the transaction to make the decision in full conscience. And finally, the realized amount of the sale is less any selling expenses that were incurred to enter into the sale. These can include advertising, commissions, and legal fees. So let's look at what the adjusted basis is. We talked about the cost basis last week, but the adjusted basis is the property's original basis adjusted to the date of disposition. This is the difference between the price paid to acquire an asset, including the sales tax and any incidental costs related to putting the asset in service. It's net of any cost recovery incurred over time, talked about in our previous lecture. But it also includes any improvements intended to prolong the life of the property or increase its productive capacity. If you upgrade an asset or upgrade a physical real property, those are capitalized and added to the value of the property. Now, capital recoveries can also include certain corporate distributions that are treated as return of capital. For example, capital assets include stocks, bonds, and securities. You acquire them at a certain cost, and then you may periodically draw from them at the amount that you contributed to acquire them. Such transactions decrease the basis of the stocks. It also includes amortizable bond premiums and easements. Each of these would decrease the basis of the property. Now let's apply the elements of the gain or loss formula by looking at an example from Sugarista. Instead of acquiring the property and depreciating it, we're now selling it and calculating how well or badly off we would be if we sold it. The property was acquired at a cost of $12,500. For book purposes, we've accumulated $10,000 of depreciation. For tax purposes, she's deducted $11,500 in depreciation, and she's assuming that she could collect about $2,500 from selling the equipment. So first, what is Sugarista's gain or loss per the books? We're assuming that she could, on the open market, collect $2,500 in cash, which is the fair market value of the property. So we'll assume that is the selling price. The adjusted basis of the property on her books is the difference between what she paid for the property and what she's accumulated in depreciation. So on the books, the property is worth $2,500. If she sells it at this $2,500 cash, her realized gain, or hypothetical gain, is nothing. She's selling it at exactly what it's worth. Now, what about for tax purposes? Remember, she can take accelerated depreciation. So for tax purposes, she's actually depreciated more than she has on her books. Again, we're assuming that they're selling the property at $2,500, the fair market value. This time, the adjusted basis is the difference between the cost to install the property and the tax depreciation, which is $11,500. This leaves an adjusted basis of $1,000, which means that her realized gain for tax purposes would be $1,500. All right, now let's say she's found a buyer and she's able to sell the equipment for $500, and the buyer is going to assume the $3,000 loan that she acquired to purchase the equipment. So now let's calculate Sugarista's taxable gain or loss. It's the same formula, realized price minus adjusted basis equals gain or loss. But this time we're dealing with a realized price of $500 cash plus the $3,000 assumption of loan, which is cash in the Sugarista's pocket because she no longer has to pay that loan. The adjusted basis of the property is the same $1,000 that we calculated in the previous slide, which means that the realized gain per books is $2,500. Now let's look at what that means tax-wise. For corporations, gains are included as regular income. There's not a special capital gains treatment like there is for individuals. So the realized gain per the books is $2,500. She's taxed at a rate of 21%, which means her tax that she would owe to the IRS is $525, which means that the cash impact of her sale, or the money in her pocket after completing the sale, is $1,975. Now, it's important to note that the seller only pays taxes on the amount above what they purchased. They're not taxed on the initial recovery of their investment. Conversely, the seller doesn't pay taxes on loss upon sale or exchange. This is considered entirely a tax-free recovery of the investments. Now, as a general rule, the seller does not pay taxes on a loss because it is considered a tax-free recovery of their investments. But there's a couple of cases wherein this isn't true under the tax code. One of them that the book discusses is related party transactions. These are losses that result from a direct or indirect sale or exchange of property that's sold or exchanged between related parties. Such losses are not recognizable. Now, what do I mean by related parties? As far as the tax code goes, related parties mean members of a family, as well as any individual who owns 50% or more of the value of outstanding stock of a corporation. That individual is effectively the corporation. This loss is prohibited because its allowance would create a possibility for losses to be shifted between and amongst parties so that the people with high tax liabilities can assume the loss so that they pay lower taxes. The IRS doesn't like that. Another example of a disallowed loss is when a wash sale occurs. Effectively, this is a loss that's incurred when a stockholder short sells their own stock. Here's an example. Assume you owned Boeing stock back in 2019 before their MAX planes all got grounded. Their stock was doing really well, they were selling a lot of airplanes, and the stock price was rising. When the Boeing MAX aircraft got grounded, the stock price began to fall. And I believe their stock price is still falling because people aren't flying because of the pandemic. You decide to sell the stock, take a loss, use the loss to offset your other capital gains, or if it's less than $3,000, to offset your ordinary income. And then you use the proceeds from the sale to buy back the exact same shares of stock. On the one hand, you've already taken the loss, but now you've got stock with a lower basis, so that when Boeing stock actually comes back up, which you hope against hope that it does once planes are able to fly again, you are able to collect a larger gain. The IRS disallows this practice because the shareholder hasn't had an economic change of status. They still own the same number of shares, they're just shares purchased at a different price. The IRS requires the purchaser to tack back on the loss when they compute the basis in this case. So effectively, the shares have the same basis. Some other examples where gains and losses are not recognized have to deal with non-taxable exchanges. This occurs when a business owner or a taxpayer elects to exchange an asset instead of selling the old asset and using the proceeds from that sale to purchase a new asset. Under option 1, the taxpayer would potentially see a gain on the old asset, incurring taxes on the transaction. The basis of the new asset would be whatever they paid to acquire it. Under the second option, they trade the old asset for a new asset. They don't have to record the gain or loss until the new property is disposed. They adjust the basis accordingly, such that the basis of the new property is the basis of the old property. One example of a non-taxable exchange is the like-kind exchange under Section 1031 of the Internal Revenue Code. These exchanges allow a taxpayer to swap a real property that is used in a trade or business or held for the production of income for another real property without tax consequences. This type of exchange is mandatory, meaning that if the taxpayer is eligible for such an exchange, they're required to take it. Now, the exchange criteria are met individually, such that both parties have to meet all three conditions for it to qualify as a like-kind exchange. Therefore, one of the parties can enter the non-taxable exchange, or both parties can, depending on which criteria are met. So what properties count for this like-kind treatment under Section 1031 of the Internal Revenue Code? Inventory swapped for a machine used in business, land held for investment, swapped for a building and land held for investment, shares of stock swapped for equipment used in business, light-duty business truck swapped for another light-duty business truck, automobile used for personal transportation versus automobile used in business, and finally, land held in investment in New York City swapped for land held for investment in London. The only item that qualifies for like-kind treatment under Section 1031 is B, because this is the only exchange of real property for real property. Now, the tax code defines real property under this exchange broadly. It's really real property for real property that's owned and traded in the United States only. So let's look at the other options. Inventory isn't real property, and a machine used in business isn't real property. Item C deals with a capital gain property swapped for a personal property. Item D deals with identical exchanges that might qualify for a tax-free exchange under other sections, but they don't qualify for the Section 1031. It's personal property swapped for personal property. Item E doesn't count for the like-kind treatment because it deals with personally owned property. And item F looks like it might be a like-kind real property transfer, but it's disqualified because you're trading a domestic property for an international property. Now, if anything other than the like-kind property is exchanged, there may be tax consequences for the taxpayers. And let's look at a couple of examples. First, if solely like-kind property is exchanged for solely like-kind property, neither of the parties recognize a gain or loss. The basis of the property is the basis of what's exchanged. If cash boot is given, the party that gives the boot doesn't recognize a gain or loss. If non-monetary boot is given, the gain or loss is recognized to the extent that fair market value is not equal to the adjusted basis. So if the property that's given in addition to the property that's exchanged is gain property, then the taxpayer giving the boot might have to write off the gain or the loss. And finally, the party receiving the boot, the loss is never recognized, but a gain is. Now, another class of property wherein a taxpayer can defer the gain involves involuntary conversions. This is an economic transaction resulting from condemnation of property, destruction of property, theft or seizure of property, or sale or exchange under threat of condemnation. Under some of these circumstances, the insurance company pays the taxpayer. In others, the government pays the taxpayer to forcibly take an asset. This is a transaction that the taxpayer didn't see coming. Depending on who and how the property is used, the taxpayer has a couple of options when replacing the property. For business owners who don't occupy the property, they can replace it with a similar property. But owner-occupants are required to obtain functionally similar replacement property. As long as the taxpayer replaces the property within 2 years or 3 years of the tax year in which they received the proceeds for the involuntary conversion, they're not required to recognize a gain. And again, losses are never recognized for such a transaction. Another special gain exclusion applies to the sale of real estate by individual taxpayers. The code provision, Section 121, allows taxpayers to exclude up to $250,000 worth of realized gain on the principal residence, which is the place where they spend the preponderance of their time, if the home is owned at least 2 out of the 5 years preceding the sale of the home, if the home is occupied by the taxpayer that is used as the principal residence at least 2 out of the 5 years preceding the sale, and if the taxpayer didn't take advantage of that special tax provision in the preceding 2 years. Now, the first 2 requirements, the 2 out of 5, owned and occupied, are generally met in conjunction with one another. That is, the person lives in the home and occupies the home at the same time, but they can be distinct as well. And there's a number of reasons why that would be the case. If the taxpayer rented the home for part of the time, if they bought the home and then moved there later, any of a number of reasons. Now, what if the taxpayer is forced to move and forced to sell their home and would incur significant economic hardship as a result of the gain incurred on that move? Well, the IRS, in its infinite compassion, put in a couple of exclusions to the 2x2x2 rule, allow taxpayers to ignore a portion of the gain on sale if certain circumstances are present. The first of those circumstances would be a change in the place of employment. If the taxpayer's commuting distance increased by more than 50 miles, they're justified in selling their home and ignoring a portion of the gain on that home. The second exclusion is if health issues force a relocation. For example, if a doctor recommended a cancer patient to relocate closer to Houston so that they're near the MD Anderson Cancer Center and have good doctor justification for doing so, the taxpayers can ignore a portion of the gain, even if they violate the assumptions of the 2x2x2 rule. And finally, a number of unforeseen circumstances. One of these unforeseen circumstances is an act of God or an act of nature or an act of man that makes the property uninhabitable and wasn't known about at the time of move-in. Lily and Marshall, as you see here, learned about their home being downwind from the sewage treatment plant after they had already closed on their home, so they might be able to get an exemption from the 2x2x2 rule. And finally, a taxpayer may qualify for partial exclusion if only one of the twos is violated. In this case, you would take the percentage of months in which all 3 conditions were met, divided by 24, and use that percentage to figure out what percent of gain you can exclude. The remainder of the gain is then taxed at a capital gains rate. This concludes the lecture. We'll get to problems and practice in the next lecture.